Hello, friends. Welcome to Nirmal. I'm Piyush Jain, and today we are bringing to you a conversation for a new IPO. A company which is into the hospitality space has been carrying a brand across India, and we actually been a witness again to the rise from the perspective of both in the number of keys, from the perspective of the business which they've done, and they've also delivered again some sort of good returns again from the perspective of recent financial performance. Um, Joining us on the show today is the management of Juniper Hotels Limited, Mr. Arun Kumar Saraf, the CMD of the company, and Mr. Varun Saraf, the CEO of the company. Gentlemen, welcome to the show.
Thank you very much, Piyushji. Thank you, sir.
So Juniper is about the significance of the Hyatt brand. Help us understand basically how this brand association happened, when actually the family or when actually you started to think about investing into hotels, how this association came up, how the investment came up. Please take us through the journey.
Thank you, Piyushji. You have to understand that we as Sarafs have been a hotel owner and developer for last 50 years. My father built his first five-star hotel in Kathmandu called Yati Hotel. That continues to be part of the family now and still continues to be number one, number two in the marketplace. In Asian Games time, he opened his first hotel in Hyatt Regency in Delhi, and at that time, Hyatt was roped in as a operator for that property. And in that time, we were Asian Hotel was this company, and we built three hotels in that platform, and they were under management contract with Hyatt. In
So, so,
1990,
so, so which year that was?
I beg your pardon.
Which year that was when you started around Asian Games?
In 1982.
82. Okay, sir. Please carry on.
1982. Yes, 1982 was our relationship where it started with Hyatt as an operator for us. In 1998, I acquired this Grand Hyatt Mumbai site in Kalina. And at that time, Hyatt owners were very keen to participate in equity with us. So it was not Hyatt actually, but it was the owners, promoters of Hyatt who wanted to invest in this company. And we became joint venture partners, and we built a new platform, Juniper Hotels, which was to develop hotels in India owned by ownership under the management of Sarafs, and Hyatt owners, which were Pritzker family out of Chicago, were our shareholder. And in 2009, when Hyatt was listing, Hyatt as a management company was listing on New York Stock Exchange, at that time, all the Pritzker's families' hospitality assets were moved into Hyatt because they didn't want to have multiple platforms for hospitality. And that's how Juniper moved from being a Pritzker family ownership company into Hyatt fold. So Hyatt technically is not actually a hotel developer or investor. They are more of a global standard operator. And this is a very, very unique partnership that we have with Hyatt because they are also a significant owner. And it gives us a lot of confidence in the company that we have their, what they call in English, skin in the game. So as an operator, when they have their investment, then they are much more particular and gives a confidence to me as a co-promoter with them. And also I expect that the new shareholders who will come in the company will also take a lot of comfort for having an operator also having a significant ownership in the company.
Right, sir. As I understand, about 1800 plus keys you have across luxury, upscale categories with Hyatt. Help us understand where all these properties are there. I think about 7 hotels you have with them. Take us through the properties, sir.
Sure. So our flagship asset is the Grand Hyatt in Mumbai. It has 665 keys, which is 547 rooms and 116 service apartments. This was the largest hotel when it was built in 2003. And as part of our growth plans, we will be adding more rooms and making it one of the largest hotels again. Our second asset is the Andaz at New Delhi at the airport at the Aero City. Again, a 401 room asset, large banqueting space. And right next to the asset on the same plot, we have the Hyatt Delhi Residences. It is 126 service apartments. So we have about 245 service apartments in our portfolio, which complements the room business. This is more long term. The other two assets, if I had to, it's Hyatt Regency in Ahmedabad. Again, big asset, 211 rooms. And in Lucknow, we have an Hyatt Regency Lucknow as well, which is 205 room assets. Apart from these four big assets, we have two other properties. One is in Hampi. This is located at next to the JSW Steel Plant, next to the Hampi UNESCO World Heritage Site. So it gets complementary business from both leisure and business. And we have another hotel, upscale hotel in Hyatt Raipur, 105 room asset. So we are spread across the country, but our focus is the two metros, Delhi, Bombay, which generates about 78% of our business.
Right, and I'm curious to know because I've almost seen half of your properties. So I'm curious to know actually from the perspective that from a business perspective, from a profitability perspective, are all these properties profitable, or there is some gestation between for some properties?
So at this stage of the business, so we are profitable across all our hotels. I think COVID was a time where we actually did the industry went through what it did, but coming
Sure.
out of it, the efficiencies we've been able to drive and sustain. I think 2 years through now, I think all the properties are highly profitable. The larger assets like Bombay are giving 50% plus profitability at the unit level, and the smaller ones are touching almost 35 to 38%. So overall, as a group, I think we sit about 43% range for the units, which is probably the highest in the industry.
Of course. And how's the sort of food and beverage business doing across the categories? Because I was seeing your F&B business consistently is increasing. Like as a percentage of revenue, we are almost touching now 30%. Last year, I'm not aware about this year, like, but
Sure.
last year around 30%. 2 years before that it was 24%. What has been the reason? Like, what has been the changes which have been done?
So F&B contributes to about 33% of our overall revenue. Of this, banqueting is almost 60 to 65%. I think where you see that increase is happening through banquet. All our assets have large amount of MICE spaces. Bombay has about 1.5 lakh square feet. Delhi also the similar size. Ahmedabad, Lucknow also have the largest banqueting facility in their respective cities. So what you're seeing, that growth is coming because of banqueting. Banqueting is highly profitable as
Yes,
of the overall F&B
it
component.
usually is the highest margin business, hospitality.
Absolutely, it is. And what has happened is, I think the demand has come back, and we're seeing a lot of domestic companies holding their events. Last This year, actually, 2023, we saw the push because of the G20 happening. The World Cup was there, so a lot of events that are happening in cities, especially places like Ahmedabad, Bombay, Delhi. So being present in those cities and the push that we're getting has allowed us to increase the F&B component quite considerably.
Right. And overall, like, how has been the room utilization, like on a key basis, like what sort of utilization we are trending on?
In terms of occupancy, I think
Occupancy, yes.
at the overall level, like, we are about at 75%. The big assets in Bombay, so if you consider 547 keys,
That's
I
very good,
think
actually.
so at 75% we're there, and I think even the last quarter we were able to push up to 80%. So we see this actual trajectory continuing because we believe the supply in the market is not coming in. Whatever had to come in is already in. There are a few limited assets which are going to come both in Delhi, Bombay. And I don't believe new hotels were being built until last year. So whatever even if something starts today, the time frame is 5 years out. So what you will see is these high occupancy rates continue, and that will also allow us to push the rates higher. So we have a good runway in front of us.
So this is why I was asking you, because revenue is increasing, and uh, basically, if I look at the last 2 years, and I think the acquisition would have combined. But there are three questions here, like one by one. First question is, we saw almost doubling up of the revenue in last FY23. So help us understand, was there any sort of aggregation, acquisition in those numbers?
So if I had to, so there are two parts to that, right? So post COVID first year, the revenues were still low. So I think what you're seeing is the doubling up is the general actual growth in, not the growth in the market, the catch up to what it used to be.
Also,
What
are you saying that 308 crores to 666 crores, it's all actually the demand which has resulted into this?
Oh, absolutely. I think if you actually see the numbers of 23, so let's not forget March 22, we had that second sort of wave that we call, right? So business only picked up in the summer of 22. So the FY23 number is still on a lower side. What you see in FY the next year going forward is actually demand picking up, as well as an acquisition of a company that was owned both by Sarafs and by Hyatt, Chartered Hotels, which has three
Hmm.
assets in it, right? So they are about 400 rooms with a top line of about 100 crore rupees. So there is a contribution of that comes in, but overall, it is the demand in the market and actually the coming back of the industry, which had actually gone down in the doldrums.
Sure. And this new acquisition right now, so where it stands on the margins versus your blended margins?
So the luck. So if you had to see at a overall group level, I think it's at about 40 odd percent. The Humpy asset is extremely profitable, and so is Lucknow. So when you combine that, I think it actually gives us a good sort of overall margin in Juniper as well.
So when we go to the bottom line, sir, like if I look at the restated profit of the last year, it's almost almost flat, but like 1.5 crores marginal red figure. What's the reason for profits when the revenue has already shot up? Occupancy is stupendous. 75% in your luxury space is very, very good, and F&B is doing good. Then, so what's the reason for actually almost one and a half red figure in the net profit?
You go.
So basically, if you look at it, balance sheets of the hotel companies, the
Mhm.
profitability is very, very significantly impacted by the leveraging and the
Mhm.
cost of borrowing. So if the leveraging is on the high side, then your profits gets depressed post for before the tax. So what
Yes.
happens actually is that in the COVID times, this company actually we had to borrow additional funds to service the old debts and meet our obligations over the 2 years. So there was a bulge in the growth in our increase in our borrowings. So it has impacted the balance sheet. But post this IPO, 1,500 crore rupees would be used to pare down the debt. So the debt from the banking will come as low as 400 post this thing. So you have almost 250 crore rupees being used for debt servicing, which would come down to a negligible number. So this was the real. I mean, if you understand the balance sheet, is basically the interest cost that was going to impact the balance sheet significantly this year.
Yes, sir. I was looking at the numbers, and that's why I asked you this question because the sort of real worry was that EBITDA to finance cost was around 1.2, and that perhaps was playing a part. So, and now I think the leverage ratio will become very, very good because almost you're paying off 75% of your debt. Uh, from the perspective, if I just recall your number, which you just said, what was the average cost of debt?
It is about 10.86%.
10.86%. So roughly on a net level, net borrowing level, you actually would be paying close to 2,100 crores of not 2,100, 210 crores of interest about, sir.
Absolutely.
Right, and that basically implies, what can I assume that 150 to 160 crores of interest cost will now go away once you pay off the
Actually,
debt?
actually, about 175 will go away. We will end up with about 35 to 38 because the borrowing cost will also come down. It will be all refinanced. And at present, the company has a triple B rating, but we see that it is going to improve significantly and the cost of borrowing will come down more.
Right. Is there any loss carry forward benefit which is there?
Yes, there is a significant of loss that is on the balance sheet, and I think the company would be having a no tax situation for next 2.5 to 3 years. So we do have about 700 to 800 crore rupees of carry forward losses that can be adjusted.
Right. So which implies we're talking about almost a 170 crores benefit coming to the bottom line. And that perhaps is the single most important story which our viewers should really take note of. That from this IPO, company actually deleverages by a huge margin, and then also actually the interest cost saving along with the tax
Tax relief.
benefit that basically is going to straight away impact the bottom line very positively. From the perspective, sir, we just did not touch upon for our viewers the actual fundraising number. What's the actual fundraising you're doing?
1,800 crore rupees is the actual size of the fundraising. All of this is coming into the company. There is no OFS by the shareholders in this offering.
Right. So which implies 300 crores more is going to go into the balance sheet. Any sort of plan of how you're going to use that fund?
Yes, at this moment, these funds, whatever we are taking from the market, 1,800 crores, this is all of it is actually growth money. I need to
Hmm.
explain this. The whole purpose of this IPO is to create access to new capital and a large pool of capital that will allow the Juniper to grow. So far, Juniper, what I call Juniper 1, has grown on the strength of its two promoters, Hyatt and Sarafs, and we
Hmm.
have reached this milestone point where we need to have access to a larger pool of capital to grow faster. We have
Hmm.
been growing at a steady pace of two hotels, one hotel in every 2 years. But I would like to see more stronger pace because the opportunity is much more there, and opportunity in terms of development and in acquiring new assets, and also in terms of what the market is now looking forward to. I mean, almost a double-digit growth. So all this leading to this to 1,800 crore rupees is new growth money. First stage, we are using it to deleverage, and as and when we will get, opportunities, we may want to re-leverage, but it won't be re-leveraging to this level, but it will be re-leveraging to 1.5 to 2 multiple of EBITDA. But
Right,
that's
sir.
going into the future. But I would say next 3 years time, not immediate.
Okay, sir. One strategic question, sir. Are you looking towards sort of managing more hotels, or looking to sort of develop more greenfield hotels?
We are actually not a hotel manager. Hotel management company is done by Marriott and Taj and other mixed
Yes.
hotel companies. We are actually a marquee asset owner. We develop our properties, or we acquire brownfield properties, or we acquire even fully built properties and reposition them, and trying to we make. So our goal is continue to be acquiring new assets by either greenfield development, brown, or even full acquisitions to grow this company.
And
We are not
the target
looking.
will be 100 key plus.
Oh, target is actually we are going to be adding almost like 700 keys in next 2 years by way of our only acquisitions, and we intend to add 300 more keys onto our existing Grand Hyatt asset, where we have the opportunity and we have the drawings being approved, and all this is actually in the process now as we go forward.
700 keys over the next 3 years.
700 key over the next 3 years period, and 300 keys over the next 5 year period. 7 plus 3,000 keys will be added. 300 will come through additional keys on the Grand Hyatt property itself.
Okay, and that sounds good. And the usual, like we can't forecast right now, but the usual on an average benchmark historical recent acquisition perspective, what's the sir average capex for you? Like for
Uh, See,
like
actually, if you look at it, there has been no capex which we have made since 1990, 2018 19, when the last hotel property, which was the Delhi Residences, opened.
no sir. I was asking from the perspective that over 700 plus three, which is 1,000 key, what would be the average cost of acquisition or cost of building a per key?
Yes.
Like how should we imagine that?
Okay. Sure, I can share that. Uh, it will be about 2.5 to 3 crore rupees would be per key acquisition cost, and that would still be lower than if you were to go and develop a greenfield project. But if on the additional rooms in Grand Hyatt, the 300 keys that we will be adding here, they will be at 85 lakh rupees per key. So these are really a significant opportunity at very low cost. They are low hanging fruits that will bring huge amount of benefit to the company.
Right, sir. I think that sounds good. Perhaps with now internal accruals every year, I think, and also with the 300 crore, which is going to be in your chest, the war chest, I think that perhaps is going to help in faster growth. And with all those good wishes, we extend all the wishes to you for a very successful IPO, and hope to stay in touch with you after the March quarter results.
Sure. Thank you,
Thank you,
Piyush.
Piyush.
Thank you
Thank
very
you.
much for having us. Thank you, sir.
And dear viewers, hope you enjoyed this conversation about Juniper Hotels. For now, it's a wrap on the show.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.